Welcome back to Reformed Millennials, the podcast where finances, economic trends, and sports intersect. Cam and Joel help listeners better invest their time and money. Also, it's important for listeners to understand that investing in equities, fixed income instruments, and/or alternative asset classes involves substantial risk of loss. Any action you may take as a result of the information presented in this podcast is your own responsibility. The information in this podcast is presented as a general educational, informational, and entertainment resource only. While Joel is registered to provide investment advice, this podcast does not provide individualized investment, tax, or insurance advice, nor is it meant as a recommendation to any listener to buy or sell any specific securities or otherwise take any other form of investment action. This is an excerpt of the full legal disclaimer that's available on the landing page of this podcast, which includes whether Cam Pitchers or Joel Shackleton have any ownership or interest in the specific securities discussed in this podcast.
Good morning. Happy Thursday. Cam, did you hear in Phoenix, Arizona, that half of the people in hospital right now are there because they fell on the concrete?
Yeah, it's 40. It's been, I saw it said 46, feels like 48 when I checked. I still have it pinned on my weather app from when we were down there in the winter time. And it honestly is incomprehensible that anything can get that hot. But
48 degrees Celsius? What? Are you kidding me?
So we would have been in big trouble if it was 48 degrees Celsius when we were there. Not to get into details, but
for sure. It might have helped me sweat out a few things, but I think that
exactly, yeah.
I think that my group chat, my family group chat, which is generally more progressive than perhaps our group chat with our friends,
the peer group,
yeah, is very concerned about global warming again. I will say to my wife that if she is so concerned, which I think she is genuinely concerned about, we have a child, we're worried about the climate,
the future,
she should stop buying stuff online and shipping it via airliner to our house. That would be good for the environment to stop.
Well, we just need those drones, right?
Right, because the drones are on battery power.
Bang. All good. Solved.
Yeah.
You don't need to mine anything for that, right?
There's a lot of work that needs to be done, I think, to help satisfy some of our guilt. But generally speaking, it's not looking awesome when you take into consideration this was the hottest month on human record across the globe. July was. So that is terrifying.
Yeah, some of those predictions are maybe coming to fruition for sure. I think that combined with all of the, I think similarly to the, I mean, I'm no expert on this, so let's definitely stay on the edges here. But
definitely.
I mean, the amount of, it seems like we talked about from the economic perspective over the last 3-4 years. We talked about all these once in a lifetime events, and then you have all these once in a lifetime weather events happening that seem to be happening way more often. It's definitely another challenge and something else that's going to be affecting things going forward from an economic perspective as well. I think it's a consideration. I think that's one thing that you had shared with me. I think another from your fave guy, Bob Elliott, talking about interest rates and whatnot. I know you want to dive into that a little bit. I know we just had another quarter point raise yesterday from the Fed meeting, and I'm sure I know there were some interesting tidbits in terms of the narrative of you've always stressed this, that the announcement is one part, but then the press conference after with Jerome Powell is almost more important in terms of understanding what the rhetoric and what the thought process is going forward. So I think we will dive into that too, but it is funny how sometimes the effect on it's truly amazing to see the macro of how it can affect your portfolio. So things like weather events and the cause of those things to, I think one of the articles you shared this week is talking about the effect of El Nino on the on the rhetoric behind supporting why something might have gone up in cost or the rising food costs. So if you have crops that are decimated by inclement weather patterns for a 18-month period, then that hits your wallet, and you don't think about those kind of things.
No, 100%. I mean, so what?
Let's get into the Bob Elliott stuff first. I think.
Yeah, we don't want to talk about Arthur Burns and how. So he was the former chair of the Federal Reserve back in the
70s, I think 70s, it was.
Yeah, which was obviously a tough time where you had massive amounts of inflation, and he had drawn some. Basically, the weather caused a lot of price pressure in commodities, which then drives inflation. Makes a lot of sense. It's just funny to go back and look at past history and issues that were occurring then, what they drew as the reasoning for why we had inflation and how similar it is to today. So you'd brought up Bob Elliott, and he's been really great throughout this whole entire inflation cycle.
Yeah, I can't stress enough again for someone who would be very like on the moderate scale of following this stuff, and obviously like I've said before, being on this podcast every week is my kind of deep dive into things. But as a follow, like he sets things up so well and is pretty eloquent in how he lays things out. And so I can't stress enough how great of a follow he is for sure.
Well, yeah, he even circles things on charts for
and highlights things. Pretty good visual.
Thank you, Bob. And for those that maybe don't know who he runs a fund of funds, but he used to be the chief investment officer at the largest hedge fund in the world. Very intelligent guy. He had a video that I think more people should listen to. He's starting to do some more podcasting. So check that out. But in this thread, he said that there's a few things that the market isn't seeing, or at least that he's disagreeing with. So he keeps reminding everyone that the most important thing for the Fed and for the Bank of Canada has been the employment market, or shouldn't say market, but employment rate. And it's still insanely tight. That means that you're not seeing people getting laid off, which is what the Fed wants to see, because they don't want to see a continued inflation in wages. Wage inflation causes price inflation and demand for goods. They want to kill demand for goods, at least to the point in which prices stop going up. Very tough to do if people keep making more money. Now, this isn't to say that they want people to stop making more money. They don't want people to be making more money.
They want it to be balanced.
Price of goods. It just wants to be balanced. It needs to be stable, that they can predict it. That way, the economy can get back to normal. So now, what he's pointed out is that the market, based on how it's priced right now, is pricing in 12% earnings growth going into 2023-24, and then a 5 rate cuts in 24. And that is a lot, given the fact that they continue to talk about how hawkish they are, the fact that they're not done the fight with inflation. The market doesn't buy it right now. You take a look at the VIX, and it's sitting at 1293 as of this podcast, and you just had a rate increase from the Federal Reserve, and the market just isn't believing them anymore. They've effectively said, we think that you've won. We see there as being and you go and you listen to, last week we had all the banks reporting earnings, and they, on all of their calls, they talked about how the medium-sized businesses are not seeing the recession that a lot of market participants were predicting last year as they sold off stocks down 25, 30, 35%. They're seeing a soft landing. It's clear that the economy is still strong, the consumer's still strong, employment's still strong, so they're not super worried. Now, that's being priced into stocks, but it's tough to see what the Fed wants to accomplish. It's long been said by investors that you don't fight the Fed. Right now, it seems like investors are fighting them, telling them that they're full of crap, and they're not scared. So I'm not here to tell you which way it's going to go, because I don't know. But I do believe that all of these most recent increases are vanity increases. They're filling their monetary gun up, and they're going to shoot them as they need it on the way out and on the way down. So,
yeah, rather than getting ahead of it, letting that lead.
Well, I think he's saving face. In the case of Jerome Powell, he needs to. He recognizes that he didn't increase rates fast enough back in 21, 22, and he doesn't want to be the guy who let off the gas, the proverbial gas, on raising rates, as the economy is still pretty strong, because he hasn't seen any cracks yet. So, with the exception of the banking crisis that we had in the first quarter of this year, I think that we're at a point where he can almost claim victory. I know market participants have, investors have, but he's being extra cautious because he has to save face. He has a reputation to maintain. So where are we going? Right now, we're this month, or this week, sorry, we have earnings season, but big tech is reporting. We had Google and Microsoft out last week, or yesterday and the day before. And Google blew the doors off. Amazon had kind of a mixed bag, but generally speaking, it supports the fact that the stock's up 40, 50% this year. These big tech companies are dragging everybody up, and they're doing a phenomenal job of growing and expanding their businesses in the face of what is a pretty competitive market. So I feel bad. You have 494 companies in the S&P 500 that nobody cares about, because right now the only thing that matters is 7 businesses, and it's sad to think that we've gotten to the point where there's only these businesses that matter, but they're doing well. And from an investor's perspective, if you're not overweight them, like in my role, you're getting smoked. Imagine just being a small, medium-sized, or even large cap growth investor or value investor right now. You're toast, because you look at Apple and it's trading at 40 times earnings, next year's earnings, or Microsoft, it's trading at 35 or 40 times next year's earnings. By most value metrics, that wouldn't qualify. So you're kind of in this you're filling your basket with all these businesses that if you're talking to your clients about them, they're like, well, I don't know what that is. What do you mean? I don't buy any of that stuff. I want to own what I use.
Why do I not have just 8 stocks in here?
Yeah, this is stupid. They've done so well for 12 years. You're clearly not smart. When in reality, that person's pretty well educated. He understands the business. I mean, if you look over the last 50 years, value's always done really well. I mean, you look at Berkshire Hathaway and you're like, well, he's got all these other ones. Well, actually, as a percentage of his holding company, Apple is 40-some% or something like that. I mean, don't hold me to that, but it's a high percentage of their market cap is based in Apple stock. So this is a long-winded way of me getting to the one thing I want to talk about, which I think leads to the back half of this episode, which is the Netflix earnings were really interesting. We talked a little bit about it last week, and I talked how they're going to be raising the cost of Netflix. Right now, which plan are you
on? No ads.
No ads.
Yep.
Top tier 4K?
I don't have that on my... No, not tier.
Not as a choice?
As a choice, yeah.
So Ben Thompson did a really good job the last 2 weeks talking about the challenges at Disney. He thinks that there's a huge opportunity here. Bob Iger just recently came out talking about how the challenges of when he first left 5 years ago or 4 years ago, when he retired to just be the chairman of the board, he talked about how he left the business. He viewed there being a major challenge in television and in sports, and a lot of investors are questioning what they're going to do with those assets. And he basically came out and said that they're going to be selling off ABC, all of their news networks, if they can't figure out next steps. So Ben Thompson then wrote this piece, not just on Disney, but on Netflix, and what the new dynamic of television is going to turn into. And I think he's probably nailed this. And obviously this coincides with a massive problem with the writer's strike in Hollywood. There's a business model problem where it's viewed that Netflix is hoarding all of profits. The writers and actors and people that work in the industry aren't being paid appropriately as a percentage. And he dives into not necessarily downplaying their gripes and their problems. I think that what he was trying to talk about was that actually, as a percentage of revenue and on an inflation basis, the percentage of the pie that the actors and writers are getting is higher than it's ever been. So it's not completely justified. However, I think a lot of them, more specifically the ones that perhaps aren't on the best shows, or the ones that are maybe not the
the A-list stuff.
The A-list stuff, they're receiving less and less of the money. And it's largely because of the way in which we're compensated nowadays. The wealth accrues to the top 1%, and that's what we consume. And if they continue to have this payout of based on performance, well, that's going to continue to happen, and that's going to be a problem. So now, what am I trying to say here? I'm effectively saying that Netflix, cheap money, the grow at all costs culture of the last 15 years that millennials grew up on, where we could, when we first started going to White Ave, we had to walk home in the snow or take a cab. Then Uber came out, and it was free to get home for a while, where they would just give you free money and credits. And now they've built into our way of life this, I'll Uber there. Same thing happened with Netflix and Airbnb and all of these hyperscale Silicon Valley businesses that were funded by free money. And they're now turning on the profitability because they were required to by the market. But they've also gotten to this scale where they can demand that from us. So now we have Netflix in a position where they've completely destroyed cable. If you aren't 80, you probably view Netflix as being more valuable than your cable subscription. So if that's the case, it's pretty likely that they're now going to, especially with the most recent launch of their ad tier, create a new cable news or cable bundle. And that bundle is going to be, in my opinion, you're going to have two options. You're going to have ESPN and you're going to have Netflix, and you're likely going to do both. And you will then fight between pricing. So now you have, and Netflix already indicated that they're doing this. They're going to be raising costs on the non-ad tier. Mm-hmm. The ad tier is going to stay around $7.99, $8 in the United States, whatever, $10 or $11 or $12 here. And then our non-ad tier is going to go to $30, $40, $50, $60. And you're going to have to make a determination of whether or not you want to be non-ads, you don't want to have commercials, or you are comfortable with them at a much lower price. And the reason that is because Netflix has to pull a lever to be more profitable. That's just the way that it works. And they only have three ways of doing that. So they have average revenue per user, or I think they call it ARM in their calls. Mm-hmm. And how do they get to do that if in Europe and in, we'll call it, poorer countries where they have Netflix subscriptions, it's tough to drive revenue growth there. They have user growth, but they don't have this same amount of money, so they can't charge the same amount. So they need to start to push and pull different levers, and that one's going to be ad-based. That is going to be their major focus because there is so much opportunity in the way in which you deliver ads. Facebook's done this. They're running $130, $140 billion business just on advertising. Netflix would love to be able to do that. Can they? I don't know. Mm-hmm. I think a lot of people spend as much time on Netflix that they do on Instagram. So it'll be interesting to see where it goes. But my belief is that there's going to be a $50 a month Disney Plus, and there's going to be a $50 a month Netflix, and there will be nothing else.
So I think the interesting piece that I'm trying to put together is the move to live events for them and how that works with ad space, because of course, like we're watching the Super Bowl, the biggest marketing event for advertisers each year in terms of North American sports. So that is if the Super Bowl were to move to Disney Plus, for example, and that is going to be a live event that you can stream through the platform. I think the experience for the user would be no different than what they're having right now, right? Because it's a live event. You're going to have the commercials. You're going to have the ad buys that are going to be built into that that are now going to be obviously directed. Right now, I'm assuming some kind of relationship between the NFL and either Fox or whoever is producing it that year. I know it switches each year, and that's the relationship. So now, how are they going to move into the live event space and structure that through the platform? I think that's probably the piece that they're trying to figure out.
Well, that's
be the hardest to do.
I think what they're really worried about though with that is that they don't want sports to be too powerful. So they're always concerned that they will be able to demand massive annual, what do they call it when they go and they negotiate their 5-year deal? Their rights.
The rights, yeah.
The rights.
Yeah.
They don't want to be able to demand that and be too important inside of their bundle. So that's why they want to probably team it with Disney and their suite there, where you have Pixar, you have the Disney suite, you have Marvel, you have all of these massive assets. They could then at least go back and say, no, you guys are benefiting from us having this inside of Disney Plus.
Right.
And really what they're trying to do is make it so that sports doesn't stand so tall, right? Because largely the reason why you still subscribe to cable bundle is so that you can watch live sports. There's no way it's for anything else. It's not for HGTV. It's not for all of those things that surround it. The fishing channel, for Shark Week. That's not why you have it. It's sports stands so tall inside of the cable bundle, and it demands all of the revenue, and everything else is just being dragged along with it. And while that has been a benefit for a long time, I mean, look at what's happened to 1260 radio in this city. It's not profitable at all. And if it wasn't for large sports networks and how much money they generate, none of that would exist. It's really just complementary for the sake of it, right? It's supposedly just making people enjoy sports more. So that's why it's around.
Well, I think the other piece there is like when you have, that was the local radio station that you mentioned, and that's not obviously it just happened in Edmonton. We had closures across the country no more than 18 months ago as well. So realistically, I think in this specific example, I think the only one left is Toronto that's actually has like a local sports radio.
Well, our sports radio is all about Toronto anyway, so.
Yeah, for sure. Yeah, the Toronto Sports Network.
Okay.
The piece to that is, the assumption I can only make is that the success in kind of long form podcasting and even short form things through different platforms, whether that be Instagram, TikTok, YouTube, etc. It has to be a small operation in order for it to work and for the economies to scale to work. Obviously, at that larger level that some of these radio stations were at, it's all this infrastructure that was in place, all this overhead that was in place that you can't get around, or you can't make work from the size of a TSN or a Sportsnet, for example, in this country. It's not justifiable. But if Joel and Cam were employees of that radio network and then wanted to move off and do a podcast like this and have kind of a smaller operation, you can be successful. It's all about getting your own niche, your own following, and being able to grow yourself into something that's sustainable and high margin. And that really wasn't an option or is not an option for a lot of these, either you call it radio networks or regional sports networks, whatever it might be. The cost benefit is not there.
So should we talk about this Ryan Smith?
Yeah, I thought it was kind of an interesting thing. So Ryan Smith, who's...
I feel like we predicted this was going to happen 6 months ago.
Well, kind of. It's an interesting take, though, and I think it's very specific to their market. So this is kind of diving into the sports side of things a little bit. But Ryan Smith, who I believe was one of the founders of Qualtrics, they sold to SAP, I think, back in 2018, I read. I won't get too much into their company specifically, but it's kind of like a platform used to do surveys and collect data and provide analytics to various companies. So either you're, designing them for your customers or for your employees. And so they had software originally. I'm not sure what they've obviously moved to as of today's date, but essentially to gather all that data and all that information and provide it in a obviously usable way for their customers. So he was on with Jason Kalkanis on his This Week in Startups podcast. And so Ryan Smith, I'm not sure when he acquired the Utah Jazz specifically, but he also has ownership in a couple of their other major sports franchises there. And he's actually, I had first heard his name actually through a hockey podcast, because Utah or Salt Lake City, sorry, is kind of high up on the list for potential new franchises for the NHL as well. I didn't really realize this, but Utah is one of the fastest growing states in America, younger demographic, huge hub for travel as well. So, I mean, in terms of getting in and out of, or getting out of the United States, it's a big hub from a travel perspective. They do have that kind of recreation piece from a tourist perspective as well, with their kind of skiing and resorts that they have in that state. It's also one of the fastest growing tech hubs, from my understanding as well.
Also only a 4.85% state income tax rate.
And that would be another attractive thing about there, which, I mean, go figure, find me an incentive and and I'll show you an outcome. Anyway, so they are growing. But anyway, so Ryan has acquired the Utah Jazz and is kind of taking a new spin on how to get their product out to their fan base. So Utah, again, not necessarily known as a big market from a sports perspective. About 3 million people, I think, is what Ryan said, in Utah. And then they would also kind of consider Wyoming, Idaho, and maybe parts of Washington as part of their kind of their fan base as it relates to their team specifically, and maybe what could be coming down in the future in terms of other sports franchises. There isn't a lot of other big markets in their area. And so we talked about the regional sport network and the decline of, obviously, the stability of some of those agreements that were in place with, I think we talked about Bally Sports, with a lot of the NHL and MLB and NBA franchises, and the issues that came up in the last year with them having some bankruptcy issues and whatnot. So Ryan was kind of talking about how their regional sports network contract, I guess, was up for renewal ahead of a bunch of others in the market or in the league. And so they've kind of taken a new spin on how they want to deliver things, and they kind of rolled that out for the first time this year, and then they're going to have a new platform, I guess, on a go-forward basis, which for those in Edmonton and Oilers fans, it might sound a little bit similar, but originally their deal was, call it $20 million for their regional sports rights. And again, the biggest thing that I think we talked about this, and I think it makes sense, and I think we understand that, but you sell your rights, and as soon as you sell your rights, you kind of lose control, obviously, of the distribution of your product. And so sell it for $20 million over X number of years, and any dealings that are being had with those rights after the fact are with the producers. So with whatever the network is, they're going to have essentially final say on how that's being distributed to the masses. And so they were noticing that there was essentially decreased viewership as a result of things that were outside of their control. And they said, okay, well, I mean, it's a big revenue hit to not sell our rights. And rather, in how Ryan put it, is we're going to actually pay for the space. So instead of this being a revenue, it's going to be a cost center all of a sudden. And we're going to, so essentially what they've done is they've purchased space on TV. You can connect, you can have your old TV. We're sitting right next to a TV right now. You get an antenna, you go to channel 14. Imagine back in the day, the little dial, when you click over to 14, you get the Utah Jazz game whenever it's on. Don't need a cable subscription, don't need anything else, just need your antenna, connect, channel 14, Utah Jazz game. So provided free, so available technically to all 3 million people, how he put it, 3 million people in Utah. So they went from essentially being in a position where their regional games that weren't blacked out because of national or whatever, went from about 1 million to 3.1 million households that they could be accessed to. Okay. The second piece was creating this online subscription-based service directly through the team. And so the other pros to this, I just talked about the lack of control. Now they have all the control. They have control over the sales, the marketing, the production of what's going on and being shown on TV for their regional sports games. So again, if you're a big Utah Jazz fan, or if you're not a Utah Jazz fan, it's something free that you can obtain.
Okay.
And so that's what he's not saying this is like the number one idea. This is what we're going to do on a go-forward basis. Not going to change. Just taking a new spin on it. He's like, well, sure, it was like incrementally $20 million of revenue was great from a deal perspective, but they're not getting the kind of reach or the growth that they want to their fan base. And they're also not being able to connect with their fans in the same way because they don't get the information from, if Joel and Cam are Utah residents, I have no idea, but you can be watching my game, but I have no idea who you are. As opposed to like you talked about the subscription model previously with Disney or Netflix or whatever it might be. What do you have to do to sign up? Provide contact information. They're going to start. Yeah. They're going to have a way to you directly. They're going to have a way to upsell you on certain products, etc. So they've created this, and it's from my reading, anyways. The full rollout of the subscription-based options are going to be directly through the Utah Jazz website, and you're going to be able to set up for obviously game access directly, so you can watch on your computer, obviously stream that or take that and put it onto your TV, whatever it might be. And then there's going to continue to be this free option that's available through just basic antenna cable. And so obviously this is in the infancy of this kind of model, but it's very interesting to me that he's put a premium on like user growth and trying to obtain as many eyeballs as possible and trying to get as much information out of his fan base, and saying that's going to be more profitable in the long run. Is the more people I can get eyeballs on this, getting interested in the sport or getting interested in the team or what they stand for, and then being able to promote the team directly rather than through an intermediary. So again, hey, we have tickets available for the upcoming games on Saturday and Monday. Email blast, boom, there you go. Here, hey, we're having a deal on these jersey sales. All directly from the team, not through an intermediary that I think previously that would all have been contacted through. So even for Edmonton Oilers, for example, like we have the Oilers Plus, that's kind of the behind the scenes access. It's not in relation to actually watching games. It's in relation to like additional content. For this example, it's all that, and there would just be, you can watch the games here for X dollars per month, and this is where you go to watch all your regional games.
So I immediately start to think about what this ends up doing to, or how are you supposed to take advantage of the idea that these teams individually are going to turn what is largely a pretty big profit center for them. Like $20 million is not nothing.
No.
It's one John Collins a year, right? And then you have John Collins is like the highest paid guy for the Jazz, I think. Anyways.
No, that's incorrect. He plays for the Atlanta Hawks, but good try,
Did he get
Joel.
traded?
No. Joel you always claim to be this huge sports guy.
I just looked it up. John Collins, Utah Jazz, number 20, power forward.
Okay, you're ahead of the game. Anyways, he's one John Collins is what you.
And he makes 23 mil.
There you go.
Anyways, my point being is that if they're going to turn this into a place where it's now a cost center, as you mentioned, but now they're going to figure out a way in which they can generate more revenue there. But I view it as an opportunity because let's say the Edmonton Oilers do this, or the Calgary Flames, or one of the NHL teams in the United States or in Canada starts to think, all right, so our regional sports network is deteriorated. We no longer have sports radio that I think generates a ton of interest. We have Bob Stauffer left in town, which is, I mean, he does a fantastic job. I think.
But you have one option. Yeah.
Yeah, you have 630 Chet,
yeah.
Right? Maybe we need to now start to be content producers beyond what we just put on the ice.
Yes.
So they've done this with their television show, which I think was the wrong approach because that's, at least in my opinion, that's not how people are going to be consuming television and media that way. But
yeah,
what I'm trying to get to here is now you need to go and find your influencers in the city around sport, bring them in-house, and start to produce content. And I think that's probably where we're going.
Well, I think I think you're probably right. I think this is probably a little bit of a test, too, for them. Because, I mean, the example we gave with Ryan Smith, Utah Jazz here, he had the ability to do this because his regional sports network contract was up. So it's like, hey, we're going to try something different.
Totally, yeah.
right now we're in a position where a lot of sports leagues are in a position where they are in the middle of a contract that cannot be broken. But you are starting to see this rollout of internally produced content, which may or may not have a good uptick. We all kind of goofed on the Oilers for doing this Oilers Plus thing.
Yeah.
A little bit, and like, who's going to pay for that? I'm sure people are. And I'm sure they're getting some good information out of it in terms of, again, how long are people watching these things? When are they clicking off? What do they like? What do they do? What do they not like? So that can help form what content they're going to do and go forward. And then again, when this next contract is up, and I think the NHL might be, a different conversation as compared to like the NBA, and just in terms of the numbers and the scale in which the NBA has grown and has that kind of national piece, which I think like the national distribution of production is going to fall under what you talked about. It's going to end up being, I think, a partnering with one of the big streaming services, and that's going to be, so like the TNT games and whatever it might be, that's going to somehow that's going to morph into some kind of platform-based subscription model where you have as part of your $50 a month, or you pay $55 now to have ESPN.
What happens if Netflix starts buying these rights?
Well, that's what I'm saying. But at the national level, but I think at the regional level, this is a very interesting take to say, okay, well, we can, as long as the league still provides you with the ability to have your own control, the teams their own control over their regional rights, then this is kind of a interesting take to say, okay, for an NBA scales, $20 million of revenue from a RSN deal is kind of a drop in the bucket.
Yeah.
And so
this guy's a multi-billionaire. I don't think 20.
Is this worth investing in to become a cost center for the time being, to hopefully in the long term gain more fans, more eyeballs, etc., just by osmosis? And then secondly, how much can we always talk about having control. Having control of their content and their production rather than it being out of sight, out of mind, which I'm sure for a long time was awesome. It's like, we don't have to deal with any of this stuff. It's just, we've done our deal. It's, unfortunately, you have to pay for X, Y, and Z in order to watch your games, or sorry, these ones are blacked out, or whatever it might be. You now have control over everything that's not at the national level. So again, for the Utah Jazz, a team that would be, it's not the Lakers, it's not the Knicks, it's not these high profile teams. So you don't have 15 to 20 national games where that's, again, back to league control. You have all of this, you have a lot higher volume of games that you can now control yourself and control what's coming out of it from a,
and you can
you can, exactly, you have the control to actually test things out and try it. So it was an interesting, obviously he's on for a full podcast, so I would, that's I guess kind of an early recommendation to listen to that. I thought it was quite interesting. And obviously his background in kind of the tech space and starting a company and from nothing and creating something is obviously unique, because he's kind of bringing some of his, he's truly focused on how do I grow my market share and my business. And he's not one of the owners that is necessarily super interested in the day-to-day basketball operations. He's done obviously the job to say, hey, I'm going to delegate this out. I'm still obviously going to be involved and I want to understand, but I'm going to really focus on, hey, how do I take this quote unquote small market team, which is in an area that we see a lot of potential in terms of growth in the state and the city, et cetera, and how do I, benefit from that? And the best way to benefit from that, I think he's saying is they have the control over what they are putting out there and what they're producing.
And I was just looking up on the map because I had to make sure I knew where Utah was.
Mm-hmm.
It actually, that would be really high on my list of a place to move to, and I think it would be just a nicer, warmer version of Edmonton. It's directly north of Arizona, east of Nevada, so it's fairly close or in line weather-wise with two pretty warm places.
When you got the
surprised.
mountains
I thought
there.
it was further north. It's not. The Utah Jazz, when I think about it, it makes me think it's cold and I'm going skiing when it's...
Well, they do have the Rocky Mountains there, but yeah, it's an interesting... a lot of the tidbits about Utah and Salt Lake City I was not aware of. So, and it was interesting little podcast listen, and obviously the little spin between business and sports there was obviously caught my eye.
Enough to get you to listen.
Yeah.
So let's take a spin quick here to Barbie and Oppenheimer.
Yeah, let's do it.
I've seen neither.
How many, like, the memes that were out of that last week? Everybody posting.
So that's what I want to talk about a little bit. And it's Eric Seufert, who's another person that I've mentioned multiple times on this podcast, but for anybody who wants to better understand internet advertising and marketing budgets and how these large tech companies make their money, how they're likely going to strategize on the way on a go forward. But more importantly, I think what he was talking about this week was the strategy that TikTok has taken on, how they have a $1 billion user acquisition plan. Mm-hmm. But what was more interesting was the number in which he talked about and how much was spent with Barbie and the way in which so apparently they had $150 million opening week awareness budget. That is huge. Apparently that was larger than what it cost to produce the movie itself, which is interesting because you have, on one hand, you have a writer's strike. And then in another one, you have networks or these businesses that are, who produced Barbie? Do you remember? Do you know? It's like Paramount or something. I don't know.
The distributor was Warner Brothers.
Warner Brothers. Okay.
Yeah.
It was willing to spend $150 million in marketing to build up this tentpole project for themselves. And it worked. It was all the rage. But it hasn't particularly worked for TikTok, whose growth has largely stagnated. It's kind of reached its its saturation point. But I thought it was interesting mostly when you looked at the states by which the popularity of each individual movie was largest.
Right.
So when you paint a map of the United States and you have each individual state on its own,
yes,
and then you have
that graphic of
so
Oppenheimer or Barbie.
Yeah, so plus 20 would be blue, and it would be Oppenheimer. And then minus 20 would be red or pink and Barbie. If you were to just think which states would be would have gone to Barbie more likely than others, what would you classify California?
Yeah, Barbie.
So you would think that Barbie would be more popular than Oppenheimer in California?
I'd assume.
New York State.
Barbie.
Okay, this is really fun. Arkansas.
Barbie.
Florida.
I'm going to say Barbie for every single one because it was...
Utah.
I'll say Oppenheimer for Utah.
So if you go and you look at the heat map, Oppenheimer was more popular in 40 states.
But the most populous states.
But the most Republican states were the heaviest Barbie watchers.
Interesting.
Which blew my mind. Oppenheimer was more popular in California, New York, Portland, almost all through northern United States. When you went down to south around the Arkansas, the Tennessees, Florida, Texas, all of them went to Barbie.
Okay, but Barbie definitely. I have a few things here, and this is, I guess, for context, this is stats as of July 23rd, so immediately change after.
Yeah.
But so this was a little. I was gonna say tweet thread, X thread.
That's not even.
We'll get into that later. From Jonathan MB32. Just want to give him credit because he kind of summarized all this. Barbie, 155 million gross. Oppenheimer, 80.5 million gross over the first, I guess, call it 3 days. And I believe this would all have been obviously American-based information. So you consider that almost double for Barbie, which makes sense in this, from the standpoint that Oppenheimer is an R-rated movie, definitely a more a historical biopic, that kind of thing. You're never going to have the same kind of level of success, which I can get into some comparables from the Oppenheimer perspective. But the fact that you just said that obviously Oppenheimer is more popular in a higher number of states, but in the states in which Barbie was more popular, obviously that many more people went to it.
They were huge.
Yeah.
And those are larger populous states.
So more of a split potentially
Probably.
in those other ones. Yeah. It is because that was the on, which I think Barbie made. You talked about the commitment to the marketing campaign ahead of opening. I think they benefited so much by going head to head with Oppenheimer too.
Oh, it was perfect.
Because like the viralness of the fact that they're just so obviously so starkly different. I think what the Barbie movie, I haven't seen
But
it,
so
but
similar.
well, what I mean is like I think there's probably more to that Barbie movie than what you would think first blush. Like I don't think the previews necessarily.
My wife went to it on Sunday, and she said that it was deeper than she was expecting it to be.
Well, I think when you have two kind of A-list actors that are, I mean, they have both of those, like Margot Robbie and Ryan Gosling, have range. Like they're not
known for doing vanity roles.
No, exactly. So, couple more stats. So this was the first time in box office history that two movies opened to over $80 million each. It's only the fourth time that two movies opened to over $50 million each, and the first time that it's happened in a decade. The other one that kind of, well, see, this is the thing though. At this, you're not going to. I was reading some of the movies that are on this list, and it's like you obviously just get to the point where the vanity movies aren't going to play anymore in box. Like it's got to be these nostalgic or these massive events where, again, that's what they're making them. They're making them events by putting so much money into the marketing. Whereas before, I think a lot of the times it was just about, hey, if we just get this into the movie theater, people are going to go because that's what people do.
Yeah,
they go to the movie theater. And they're going to say, oh, okay, well, I'm going to movies this week. I'm going to movies next week. I'll see it next week. And they're going to get that money eventually.
Because not anymore, right? That's not a part of our society.
Like, it's not part of the fabric anymore at all. No,
we don't. I used to go to a movie every 2 weeks when I was a kid.
100%.
And now I haven't been to one in 4 years. So
yeah, part of that's us having kids. But,
sure, 100%.
But for sure, it's
never sit through.
It's just never talked about. The amount of Cineplex Odeon gift cards that I have that are just burning a hole in my pocket. But I think it is something that is becoming the most popular ones going forward, and what we're going to spend our money on are the ones that are going to be thrown in our face. There's going to be such a big budget behind it that
what do these massive boxes called movie theaters do about it? Because they used to make their money on volume.
Yes.
How can you possibly return? Probably can't. So that square footage is impaired forever as a valuation.
Yeah, well, I think the ones where you see like the quote unquote VIP theaters are the ones with having the most success. So again, they're marketing to have an experience when you go, where it's the smaller theaters or smaller volume in terms of seats, where it's more comfortable. You can have a meal there, you can have a beer there, a glass of wine. Those are the ones, and at least through the scuttlebutt of listening to our peer group and people in my network, that's like when they talk about movies, that's what they're talking about. They're not talking about going
fancy.
to the old theater. Well, but it's not. It's even when you think about wallet spend from that standpoint. If you're not going to 3 movies a month like people used to, the fact that a movie costs $22 to go to or $25 to go to have this experience rather than $8 or whatever it might be.
Well,
if you're going to one.
80. Because you're getting drinks.
Well, sure,
food.
But I mean, again, it's a one night out, I think, and so that's where I think the focus would be. But to your point, they have all this existing infrastructure and potentially, leases and whatnot. So when those are up, I could see obviously there being a huge moment, and a huge cut down and a huge problem for mall space, I guess you could call it.
I mean, I'm not sure what the Gramesians and the West Edmonton Mall and how they've been able to continue to demand the lease costs and the per square footage space. I think they have something special there in terms of what that asset is in Edmonton specifically. Mm-hmm. But when you start to think about where all of these theaters are, how many we have, it's possible that we have too many. We have one in our small town that we live in of 150,000 people, and it's not full. So I don't know where that goes. I'm interested to do this. I would love to sit down across from somebody. Like if we could get a third person in here who has a ton of knowledge about square footage, how it's the economics around it, revenue that needs to be driven from the store to justify the cost, because theaters themselves are insane. There's at our mall, local mall for 150,000 people, residents, there's a theater that has 8 theaters in it.
Yeah, it might be 8 to 10.
8 to 10.
Yeah.
And I can't even name 10 movies that have gone out in the last 10 years, in the last year, let alone go to there be that many options when you show up on Saturday night.
Yeah. Well, I wonder if the option too is like, okay, well, how many of these do we select in? Again, maybe we're oversaturated in certain markets, but what's the right number of theaters to have, and then how do we refurbish these to then create more of, rather than having 10, do we have 6 and like theaters kind of thing, and then what else can we add to the experience here at our theater that's going to make it, the longevity of it make sense? Have no idea. It's going to be very, very interesting question for them to answer, because there's obviously examples of this with Barbie and Oppenheimer, and there's going to continue to be these types of movies on a go forward basis, not to mention just this year. And there's going to be money to be made by having that product being able to be shown at your theaters, as long as there's an agreement, obviously, between the distributors of these movies and the theaters themselves. So where's their meet in the middle point in terms of creating something? Seems like a huge mountain to climb, but I don't think they're not going any. I don't think we're always going to have that option to, I think, go to the movie
I think
theater.
we should.
It's just going to be what that looks like. And again, like I said, I think in my circles anyways, talking to people, it is going to those more unique kind of theaters, VIP theater experiences, which people are enjoying more.
Yeah, completely. I think that's where we're going. We should get somebody on here. I got to find an expert in this space, that maybe a broker who sells mall space, but I'd be interested in getting a better understanding of how the math works on that. It's easy for me to understand industrial real estate because it's just like a massive box, and I can easily understand that. Whereas there's way more nuance to the shopping centers, right?
Totally.
So I don't know where you want to head to next. I don't want to talk about X and Twitter.
No, I was just going to.
It's so dumb.
I had 2 quick sports things that I wanted to talk about briefly, okay. And I think it was number one. We talked about Messi signing with Inter Miami in the MLS, and as part of his deal coming over, he's getting a piece of essentially options in terms of, I think, ownership in an MLS club, likely Inter Miami or one of his choosing, on a go-forward basis, as well as a piece of the subscription revenues on a I'm assuming the growth in subscription revenues on a go-forward basis through Apple. And that's who MLS's agreement is with. And so obviously there's no early returns right now necessarily on the number of subscription ads. I would think it's high. Like, one thing I didn't consider that I was listening to another podcast talking about was the fact that Messi's from Argentina. This is going to be the first time where he's going to be playing kind of primetime games in his national country. So how much are they adding from South America, for example? That might be a huge piece, but he started off and he has gone. He came on. He did not start the first game, but came on in the second half and scored the winning goal in the dying minutes, of course, on a free kick. And then his second game, he scored 2 goals and assist in another. So the conversation that I thought was interesting around it was whether or not him coming could potentially be bad for the sport to a degree, in the sense that, hey, this guy's 38 years old and he's ripping our league apart, and he is the only focal point, which is, again, I'm not an MLS historian, but I'm sure some people follow football quite closely, potentially here in North America, that listen to this podcast. And you've seen this example before, like Beckham comes over and kind of lights the league on fire for the first bit. And Zoltan Ibrahimovic comes over and he lights the league on fire. And these guys are all at the back end of their careers, and they're playing against quote unquote lesser talent here in the MLS. So it's, like, the long-term effect is for them, I'm assuming, is to get obviously more eyeballs and subscriptions to the service here in North America for people following the sport. So I think you can still fall in love with the sport locally or with your own brand, even if it's a inferior product compared to the best in the world. It's just, that's kind of a new concept for North America, because everything in North America is the players. Right. So I think that's something that's like slowly growing, but like there's plenty of leagues across the world that are viewed as quote unquote lesser leagues that are still very successful. Are they to the same degree as the Manchester Uniteds and the Real Madrids and the PSGs, etc.? No, but they can still be very, very successful and still work their way up the ladder to become a more prominent league. And I think having Messi here is just an amazing marketing play. People are, anytime that over the next couple years, where how much longer he plays, he's going to come to every city in North America that has an MLS team, and that's going to be a huge draw. And so I think it's great for the league, and you're already seeing dividend. He's holding up his end of the bargain, already creating all these dramatics. So I can't wait to see the returns on the subscription service ads that they have in the MLS and where that is concentrated. So whether or not that actually has the uptick that they want directly in, call it Canada and the US, and then how much of that is coming from South America and their diehard fans of Messi from Argentina and surrounding areas. I'll dovetail that into the discussion on Kylian Mbappe. Is also football news. So that was kind of went viral the last few days in terms of his offer from the Saudi. So we've talked a lot on this podcast about Saudi Arabia's, I guess, mission through their through the PIL, I believe. Private investment. Their Kylian Mbappe, for those who don't know, is essentially the next Messi, if you want to call it that way, in terms of his projected dominance. He's 23 years old, and he's already kind of won everything that he could win. By and large, the pound for pound best football player in the world right now, or at least arguably. He's not the biggest in terms of, if you were to bring Mbappe over to North America, Messi plays more, Ronaldo plays more in relation to from the marketing standpoint.
I got to mention one thing quickly. Why do soccer players, football players, have the best names? Kylian Mbappe.
Yeah, that is
Cristiano Ronaldo. Zoltan.
It does seem like they have.
They're
it's
fake.
like an actor. You know what I mean?
Yeah.
When it's like, you need to change your name. But anyways, it was widely spread that he was offered $776 million to play 1 year in Saudi Arabia for the Al Hilal team, I believe is the name of the club. And so much like their investments into Live and kind of the mission statement around it is obviously to grow their prominence in various levels of sports. So for football, apparently their goal is to become a top 10 league in terms of attracting talent.
Okay.
And so obviously, how do you make a bigger wave than getting the best football player in the world? How do you try to get them? I'm assuming offering them $776 million. So essentially double the value of the Arizona Coyotes in 1 year's worth of salary for one player. Now, it leaked out or became more clear that 776 is very contingent. I guess the base salary would be only, quote unquote, $221 million. And then there would be a bunch of things that obviously we don't know the details of what he would have to do to earn the other $500 million. And what's to say this is a 1 year deal? What's to say that he's not offered the same thing in perpetuity in order to keep him in Saudi Arabia and grow the game, etc.
There's no way they could do that, I don't think.
Well, I don't think so either, but they're trying to make a wave and make this, obviously the signing of Cristiano Ronaldo to Saudi Arabia is one thing, again, from the marketing piece, but he's not the marquee in his prime type player that you would ideally want in your league to create the attraction that they want. Now, it's already been reported as of last night that he has rejected meeting with them. Now, the world of football is like a soap opera. If you just search his name, you will find respected outlets, I would say, news outlets, all over the globe saying, he's coming here. Oh, now he's going to come here. Oh, he's going to Chelsea. Oh, he's going to go to Manchester United. Oh, he's going to go here.
Right.
The consensus is that he's already come to some kind of agreement with Real Madrid, and that's kind of one of the meccas of football. So if you want to say from a legacy play standpoint, if you're a player, playing for that team would be viewed as kind of the creme de la creme. They had kind of fallen off in recent years because they've had to sell off some of their players and had some, I think, financial issues. However, that is still, again, the cream of the crop when it comes to international football and a team to play for. And as well as the fact that he likely, again, like being a competitive athlete in his prime, he wants to play against the best and be 100%. Against the best all the time. And so could Saudi Arabia's league get there at some point where they have teams that are playing in the Champions League and et cetera? Yes, but it's going to be a slow build, and they're trying to speed things up 10 years by making these kind of deals. And I don't think it's going to work overnight, and that's not going to be the way that investment works, I think, for them.
I think soccer is incredibly difficult to
well, and the money scale in comparison to like starting a golf league And having
it's
the
not even in the same.
It's not even the same ballpark. It's crazy.
Golf is so easy compared to soccer. I think that even they aren't rich enough to take on soccer. I think soccer has more money and would. I'd be probably taking this too far.
You know what's funny? It's the rhetoric too is funny because there was a couple of executives quoted. I won't be able to say their exact. I don't remember their exact names, so I'm not going to say them. But a couple of executives quoted from other big teams, and essentially they're just saying, "Yeah, you know what? Saudi Arabia teams have as much right as we do to sign players, and so if they want to do it, they can. And they have ambition to become a big league, they can." You know what that screams to me? They could care less, and they know that people aren't going to go there that are of prominence than that matter. Yeah. Whereas the reaction from the PGA originally was obviously like, "Oh no, they can't do it. We're going to ban our players from going, etc." It's because they saw that as a legitimate risk immediately. Yeah. So that's where you can see the difference in rhetoric and the commentary coming out of this. It's
team sports is way harder to do this too. I think in many ways.
100%.
Also, it is on a whole nother scale. Like you're taking on the largest sport in the world versus golf, which is like a niche.
Yeah, which was a way better investment to make.
Mbappe is going to make more money on this deal than the revenue generated by the PGA Tour. So,
which he's not taking, to be fair,
right,
as it stands currently.
But that just to put it in perspective. So, Cam, I think we're hitting our time limit today. I have a recommendation, and that is to go to our newsletter and check out my long-form writing and podcast lists here.
It's very extensive this week.
Lots. I think for my life has finally cooled off a little bit, and I was able to consume some content, sit back and learn a little bit.
Yeah, Joel's even put the minutes that you should be starting to listen to stuff.
So that is done for you.
Tune in to that.
By the way.
I know, that's great.
Well, no, there's like a new AI that just tells you.
Oh, don't say that.
It sounds smarter.
You put effort in.
I didn't. But anyways, believe that if you want to. Take a look at that. I think that would be my recommendation for the week. Cam, do you have one?
I think I gave it that podcast listen with Cal Canis and Ryan Smith for those who kind of like the business of sport. I think that was an interesting listen, and especially coming from an owner, from a relatively new owner and a young owner, and someone who is taking a different spin on kind of running his business and running the sport.
I have to add this in because it was the best venture capitalist podcast I've listened to in 3 years. And it was Josh Krishner on Invest Like the Best was interviewed by Patrick O'Shaughnessy. He founded Thrive Capital, which is quickly becoming one of the largest and most successful venture capital firms in the world. They just recently, and they're also small. They have an 11-person team, and they run something to the tune of $4 or $5 billion. And no, it's larger than that, 14 billion.
Pennies.
So this guy started this firm at 25 years old. He's now 30-something. It's really making me think how unsuccessful I am in comparison. But his interview style, he was obviously methodical. You can tell why he's successful. But if you can get past the fact that he sounds like a robot and listen to what he's saying, the way that he answers things so clearly, concisely, but then speaks to his unique approach to investing specifically, I sent it to my brothers, and I was like, you have to listen to this guy. And I think that anybody listening would get a lot out of it. It's well worth the hour and a half or hour and 45 minutes that it might take. Really good. Otherwise, Cam, see you maybe Wednesday to Friday next week.
Yeah, sounds good. Thanks for the recommendations, Joel. See you next week.
Yeah.